The past 1 year has seen a big bull run in the stock market and likewise in the startup space where investors are looking actively for startups to put their money into. Now, I'm assuming you are a startup which has already developed its idea, its product, has done its market research, identified its target market, its go-to-market strategy, has a certain sense of scale, and are now looking to raise funds either to build a good team or for marketing spend, for scaling up in other ways, for funding the growth of your business, and all of that together. Now, in this video, we aim to be speaking about a few steps that you would need to take to secure that funding after that soft handshake that you've got on an investor having promised a certain amount of funds to be put into your company for dilution of a particular stake. Now, the first step, of course, is getting a term sheet from the investor, which would essentially specify that this is the pre-money valuation of your startup, the amount of money that the investor is now planning to put in, the manner in which they will be putting in a huge majority of startups. That manner is in the form of cumulative convertible preference shares, which could be 0.001% CCPS as they call it. The term sheet, which is essentially not over a 2-page document, would define the amount of dilution, the number of shares, the share premium. It would also look at special investor rights that the investor would look at acquiring in your company after investment, which could mean right of first refusal, right of first offer. It could mean having appointed a special director to your board of directors. In addition to it, they could also be looking at putting a board observer on your board. They could also have special rights with respect to conversion of their preference shares tomorrow into equity at the time of a liquidation event, which is you having secured a funding above a particular threshold, or your company's valuation having reached a particular threshold, or at the time of an IPO or the next round of funding, blah, blah, blah. Now, all of those terms are defined in your term sheet. After the term sheet is in order and the founder, the existing shareholders, as well as the investor sign off on that, you normally have about 60 days to execute everything else. Now, in that 60-day period, the investor is going to initiate the due diligence process, which would include not just the financial due diligence called the FDD, but also the legal due diligence or the LDD. It makes sense for you to get your CA in place to do that internally for you and plug all gaps so that the CA can provide all these documents to the investors in time and also answer their queries about any kind of non-compliance, if there is any, or to complete any paperwork. Assuming all of that is simultaneously happening, you would need to hire a registered valuer, a merchant banker, or a chartered accountant, or a combination of any 3 of these people, depending on the requirement, to value your company's share and sign off on it. This is necessary from a Companies Act perspective, would be required at the time of filing. Also, if your investors are investing from a foreign trust or a foreign entity, you might need this for RBI filing as well. So your registered valuer certificate is in order. Then comes in the idea of course, building a share subscribers agreement and a shareholders agreement. What is the difference between these two documents? A share subscribers agreement is an agreement between all the investors which are investing in that particular round. The valuation at which they will be investing, the kind of rights between them, the kind of equity shares they would be getting, or the preference shares they would be getting, how would they convert to equity shares, at which liquidation event in the future. All of that is defined in the share subscribers agreement, which is also called the SSA. Then comes the shareholders agreement, which is an agreement between the founders, who are of course shareholders in the company. Along with that, in the previous rounds, in the friends and family round, or there must have been some angel investors previously who would have been issued some kind of equity shares or preference shares in the past, and the new investors. All of these investors come together and sign a shareholders agreement, also known as an SHA, to define the rights and duties and powers of all these category and class of shareholders between themselves. That is called an SHA. Initially, it may also so happen that if it's your first round, or say, when it's when a bunch of investors are reinvesting again, you may have a single document called the SSHA, where it is only one document, your share subscribers and shareholders agreement. This document may take a bit of to and fro between investors, between the founders, and there would of course be a CA or a lawyer representing the founder, uh, taking their interest into their own hands and ensuring that the founders don't get a bad deal. Similarly, there will be a negotiating party from the investors side. This may take a couple of weeks for you to finalize the draft of. Once all parties interested have signed off on the SSA and the SHA, then a bunch of secretarial compliances have to be done. So you would be holding a board meeting to further hold a general meeting, an EGM, which is an extraordinary general meeting of current shareholders, to increase the authorized capital and to appoint or to kind of table the SSHA, the terms of the issue, to approve the fact that the company needs to raise funds from investors to fund its growth. Once all of those approvals are in order through the mode of an EGM, then in a board meeting, the board would be allotting the shares after receiving application money in a separate bank account. So you would have to open a separate bank account to receive the share application money from investors. After that money is received, you would be holding a board meeting to allot those shares. You will have to prepare several documents such as PAS4, PAS5, file a form MGT 14 with the ROC, which is essentially minutes of your EGM, where you're proposing to increase the authorized share capital and also to come out with this new share or new issue of securities and the terms at which these securities are being issued. After the money is received through a board meeting, you will be allotting the shares to these investors and filing form PAS3 with the ROC or the registrar of companies on the MCA portal. Once that is in order, then of course you need to prepare your share certificates, get them stamped from the local stamp duty office and providing them to the investors. You might also have to do FCGPR filing on the RBI portal within 60 days, which is if you're receiving funds from a foreign entity, which could be a venture capital trust or an LLC or LLP setup outside in some other geography like a Singapore, Delaware, Mauritius, wherever the money is coming from. So this in effect is the entire process in brief. A lot of founders tend to feel that as soon as they've gotten a soft approval, money is going to be hit in the bank in less than a month, which is not the case. I think it's important to be mentally prepared that it easily takes about 2 months or so at the minimum to complete this entire process, possibly more in a few times, to get this done. So patience is essential, but you need to have the right guidance to execute all of this. It's important to have a good friend in a lawyer and a chartered accountant who can guide you through this process. Share this video with a founder that you know who could use this.